Yes, you got that right. Now, here's one we talk about every quarter. You know me and my history with Uber. Um, a stock I've not been a huge fan of. There's no doubt. Not a huge fan of this one. Down 5% after hours, but we carry on and talk about it. I try to look at the positives of things. The stock is up, wow, in the last year up 83%. Seemingly very shocking to me. Obviously, you've seen this is a company that's been 100% just massacred by the year 2020. This is, you see the e-commerce companies that are seeing their business just blossom, absolutely explode because of really the environment that was created from shutdowns. And Uber, a company that completely was not allowed to do business. So one I definitely did not like. Definitely still not a huge fan, but let's look at this earnings report and see why. Obviously, the stock's down 5%. Overall, you need to consider this is a company that has a not you. I mean, this year you'll expect some very just cakewalk in terms of comps. You should, because there are times in which they were down 50% year over year last quarter, over 50% last year in gross bookings. Now this first quarter they won't necessarily see that. 2/3 of the quarter was prior to lockdowns, everything open. So overall, should not be an easy win, but you should expect a year-over-year growth out of this company because one quarter was completely just kaputs. Okay, let's look though. Quarter one GAAP EPS of -6 cents is a beat by 49 cents. Quite a significant beat on a profitability standpoint. Definitely one of my contentious points for this company is the lack of profitability. And a beat like this, it's quite impressive. Because this is a company that used to lose $3 billion a quarter. Pretty important to see a decrease in cash burn here. 6 cents a share. I'm not sure where that's going to put it in a dollar amount, but we'll see later in the press release. But impressed in terms of the EPS line, though. And revenue of $2.9 billion is down 10.8% year over year, missing by $380 million. Woo-wee. I mean, I'm shocked by that one. I don't know how that's possible personally, but seems crazy. Gross bookings, though, came in at $19.5 billion versus a consensus of $18.04. Trips came in obviously lower than expected, $1.45 billion versus a consensus of $1.54. And monthly active platform customers came in at 98 million compared to a 100.6 million consensus. Overall, rough numbers. And you see why. The companies like this that really warrant these typically very high valuations, they get massacred when they have misses like this. If you see user misses in a company like Facebook, then you see massacring in the stock. Even though I don't know if it necessarily deserves such overreaction, it's just people. Really, these big wig investors, they sink a lot of their money into just checking these numbers, as far as users, stuff like that, and not necessarily about the core of the company. So curious to see. I think that could be part of it, but those numbers are pretty disappointing. Narrowed loss. Gross bookings up 24% on the year to an all-time high, and mobility bookings down 38% year over year. Ugh. That shocks me. Mobility obviously being the main Uber platform, it just very much shocks me that it's down 38% year over year still, and one of the quarters was completely shut down. And I mentioned this before. I think ride sharing is an industry that it's not going to go back to normal just out of nowhere. It's going to be tough for people to get into people's cars, especially those who are still frightened, even vaccinated. Shoot, some people won't even won't get in cars still. They're strangers' cars. So this is going to be a long-term impact for this. You need to consider that. People just aren't going to necessarily get in strangers' cars anymore. But here's a good line for them. Delivery gross bookings coming in at $12.5 billion, increased 166% year over year. We still see that benefit from lockdown periods in which people are using Uber Eats significantly more than they did prior because they're lazy. They want stuff delivered to them. Maybe not lazy. They're quote unquote careful, you could say. They don't want to go out into the wilderness, but a lot of people are kind of crazy. Or lazy, I should say. And lazy. Crazy, lazy. All of them. So it's a good benefit for them. This is an incredible portion of their business, thankfully. They're very, very glad they're diversified in that aspect. I can just tell you that right now. Otherwise, this would be a rough quarter when you're talking about down 38%. But still, good to see the delivery business doing well in this company. And that's really been what's carrying the stock lately. I mean, it's nearly double what their mobility segment's going to do, which is the main core of the business. But now Uber Eats is the main core of the business, which is crazy. Mobility revenue of $853 million was reduced by $600 million accrued by reclassifying the UK drivers as workers. I don't know how that necessarily impacts the revenue line. It's UK drivers as workers. I don't know how that would impact revenue, personally. But that's crazy. But without that, overall was up 8% year over year, actually. So we'll see what next quarter looks like, I guess. And mobility revenue was down 1% quarter over quarter and 41% year over year. Did not help the mobility line, but total revenue would have helped. Crazy to see that. Delivery was up 28% quarter over quarter, 230% year over year. Really good to see that. If you're them for that revenue line and delivery, pretty nice. Adjusted EBITDA loss of $359, improved by $95 million on the quarter. Pretty nice. Delivery loss has always been pretty rough for them. Loss of $200 million, down $55 million on the quarter, but up $113 million on the year. So they did decrease this, or really increase this loss quarter over quarter, which is not necessarily the greatest thing, but year over year saw a decrease. So, yeah. Monthly active platform customers were down 5% on the year. Not a shocker again because I said 2 months out of this quarter of last year not necessarily impacted. So to see a decrease, it's not a shock. And don't be shocked on that. You want to see obviously next quarter what those results look like because we'll be looking deeply into those. So I really want to know how that UK number, how that impacts them. I don't know. Resolution of historical claims in the UK related to the classification of drivers. I don't know how that necessarily impacts them. I really don't know how that impacts the revenue line. Could just be the very extremely tired brain, by the way. No sleep in the last 3 weeks, but I just don't know what that would do for that line. I mean, I could see it affecting the profitability line if they had to pay him benefits or something, but just weird to see. I feel like somewhere. Oh yeah, very top here. Net loss of $108 million. That's what that adjusted out to. Really not that bad. I still hate to see a loss of revenue, but not that bad when you consider $2 billion in revenue and $108 million only in loss. I hate to see loss, but what can you consider? Overall, trips down 13% year over year. Yeah. Revenue down 11%. Interesting to see. It is just interesting to see. Net loss, though, they lost $3 billion in this quarter last year. Only lost $108 million this year. It's really good to see that because mobility has found a point where they're actually profitable. Now the question here becomes delivery, their main segment, is not profitable, so what can they do about that? Certainly one that we want to see. We look at quarter over quarter, mobility bookings dropped significantly. 38%, or 38% in mobility bookings year over year. Rough to see. Freight saw a 52% increase. Not a significant part of the business, but it is growing. No doubt. Revenue line, 65% of revenue cut in mobility year over year. Seems like a shock. 55%. They were open they were open this entire quarter. Again, I mentioned this mobility segment. It's just rough for this company. It's a crutch at this point, and it will be, unfortunately, for the next little while. I don't know. That's my perspective on the matter. Do want to look at all this nonsense explaining the business, safety developments. Come on now, your mobility segment's not working for you, champ. I get a 3 months comparison in the balance sheet, worth looking at. 8.2 billion on the total current asset line right now, compared to 9.8 billion prior. A little bit of a decrease in cash and cash equivalents. My guess is they turned it into long term, or they sold off some debt potentially. We'll see. Total assets right now at 34.6 compared to 33.2 billion. Not that bad, all things considered. Pretty nice balance sheet in terms of size there, you can tell. Total current liabilities did rise, 7.28 billion compared to 6.86. And total liabilities in general at 20.5 compared to 19.4. So overall assets rose by just quite a bit more, just a little tiny bit, 13.6 billion compared to 12.96 billion of 3 months ago. But that is still a good growth quarter over quarter there. The balance sheet overall saw a rise, so it's a benefit. Now you see the valuation of this stock. I just think it's incredible. The company I don't know. If you look on a full year basis, the company might bring in 15 billion this year. Trading at a market cap of 95 billion seems somewhat pricey. If they could manage to do 15 billion, I don't know if they could. I kind of doubt it. I think it's going to be probably closer to 12 billion to 13 billion. Market cap of 95 is a little pricey for me when you talk about a lack of profitability. I need proof that this company is going to continue that trend of profitability. It's going to be hard when their profitable side of the business, the mobility segment, just isn't bringing in the users. We're talking about 58% declines in revenue. I mean, it's rough to see. They should be hitting better numbers. They really should. It should. But regardless, that's what I got for you. Hope you have a great day.